This is Goku Intelligence providing reporting for the FinTech and RegTech industries. Today I'm covering the topic of Grayscale's application to convert their GBTC Bitcoin Trust to an exchange-traded fund listed on NYSE Arca. Grayscale applied for their spot ETF after the SEC approved the ProShares Bitcoin Futures ETF in October of 2021. Grayscale believed that this ruling showed the SEC had changed their stance on the threats of the risk, fraud, and manipulation to the underlying Bitcoin markets, since both spot prices and futures prices relied on the same mechanisms for determining their value. There's three main legal concepts I'm going to be exploring in my review of this appeal case from Grayscale. The first is the Exchange Act of 1934, Section 6B5, which requires that the rules of the NYSE Arca would be specifically designed to prevent fraud and manipulation of the ETFs listed on their exchange, and that they would be willing to act in coordination with regulators to protect the interests of investors and the public. The next legal concept mentioned throughout this case is that of a shared surveillance agreement with regulated markets of significant size. The specifics of this type of agreement might vary from case to case, yet a key phrase we encounter in this ruling is that in order for a surveillance agreement between exchanges to be effective, that it must be the case that a bad actor would only be able to attack that ETF by trading on one of those participant member exchanges. An example cited by the SEC is that used by the Commodities Futures Trading Commission. They require that exchanges would register both beneficial ownership data of all exchange participants and share transaction level details of all activity, and have agreements in place of how they would collaborate with regulators to enforce any actions. The last concept I'll explore is that of the Administrative Procedure Act, which requires that like cases must be treated alike, essentially trying to regulate the regulators, and that the SEC cannot play favorites in the way they apply their definitions or standards. Grayscale is arguing that the SEC decides that the underlying threats and risks of Bitcoin markets are acceptable to Bitcoin future ETFs, and so they must also do the same for spot trade ETFs, since the underlying assets are priced in exactly the same manner. Grayscale is thus alleging that the SEC is acting arbitrarily and capriciously by not applying these standards equally. Grayscale is also arguing that the SEC is abusing the discretion afforded to them by the Exchange Act by applying a circular logic and unobtainable standards to accomplish the market sharing surveillance agreements. Basically, the spot ETFs can't create shared surveillance agreements until other spot ETFs are approved, but spot ETFs can't get approved until there are shared market surveillance agreements in place. In my analysis, Grayscale's argument that the SEC is violating their rights under APA lack merit, simply because between October of 2021 and June of 2022, it's been discovered that crypto exchanges and their platforms have unique vulnerabilities to external factors, such as the collapse of stablecoins or DeFi lending platforms that happened in May of this year. There's plenty of contextual evidence to support the SEC's change of heart and provide reason to believe that a spot ETF would not be in the best interest of investors or the public. Further, the Grayscale's argument that the SEC is not treating like cases alike also doesn't hold merit. Because the pricing mechanisms for futures ETFs and spot ETFs have actually been proven to have a lead-lag relationship, or more simply, the prices of these two ETPs do not move one-to-one with each other or at least that hasn't been proven, and therefore it can't be said that these two situations are exactly the same and that the SEC failed to apply these standards consistently. Lastly, Grayscale is alleging the SEC is abusing their discretion in the way they define and apply the significant market test. And although I am wanting to agree with Grayscale in this simply because the SEC's discussion is very complex and perhaps even convoluted of the way this should work. However, ultimately the SEC's discussion is merely a suggestion for one possible way that Grayscale could satisfy the requirements of the Exchange Act. The SEC also discusses that if the underlying Bitcoin asset can be proven to have inherent or unique qualities that make it resistant to market fraud and manipulation, this could also satisfy the requirements of the Exchange Act. In Grayscale's application, they actually did attempt to prove this. However, after reviewing this, the SEC believes that Grayscale failed to provide enough evidence or data to support that conclusion. I think that Grayscale is going to lose their appeal in the DC courts. Gary Gensler with the SEC recently said in public comments that if the crypto trading platforms were to voluntarily register with the SEC in just the same way that NYSE or the Chicago Merchants Exchange would, this might improve their opinions. Further, the crypto trading platforms should create their own surveillance sharing agreements and voluntarily start collaborating with the SEC to assist in regulatory actions. I think this would significantly move the ball forward with the SEC's opinions of a spot trading ETF. Without doing so, it's going to fall entirely on the shoulders of Congress to pass laws that make spot traded ETFs for crypto specifically legal. But the conditions of such a law would most likely require the exact same actions of registration and surveillance, only on terms less favorable to the crypto exchanges. I would suggest that they go ahead and do this voluntarily in order to establish a relationship that favors them more. I'm going to continue to follow this issue and break down attempts from other organizations to create a crypto spot traded ETF, but until then, thank you for following along with Woku.